Investors, we are just 3 days away from the Federal Reserve's next big interest rate hike decision. And while we may have experienced a rather exciting week with stronger than expected earnings, heed this warning, more pain very well may be on the way. Now, if you are new to the channel, I'm Ari, your go-to value and dividend investor for stock ideas, which is what you're about to get in today's video after I give you a quick account update and catch you up to speed on our economic backdrop. Now, in terms of our dividend stocks, we have 7 total to run through. So tap on that thumbs up button, set yourself up for a successful 2023 by simply subscribing to the channel. And with that, let's get right to it. So after enjoying all the momentum this past week from stronger than expected earnings, my brokerage account inched back up to $107,926.59. But as mentioned, more pain may very well be on the way. So instead of celebrating what is likely a relief rally, let's get into our macroeconomic overview. First and foremost, last week and into this week, the Federal Reserve has been in their blackout period. This means Powell and the gang essentially go off the grid as they analyze and scrutinize data sets to determine and finalize their next interest rate hike decision that's on February 1st. Now, when this happens, I like to think we get a vacuum within the market, whereas any news can easily become good news because there is no real negative news from the top dogs who really determine our economic policy. And of course, with earnings season underway, we had quite a bit of an exciting week worth of news with companies reporting stronger than expected earnings. But as investors, we need to keep focused on the future, and earnings, as you all know, are results of the past. So what do I really listen in for? A company's future guidance, like Microsoft sharing their 2023 outlook, which looked nil amidst all the other companies who are in full preparation mode for an uglier market in the coming months. However, we did get some pretty significant data sets worth of economic news this past week, which is important to note, with the first being the initial jobless claims coming in at 186,000 on top of GDP news, whereas we saw signs of a slowing economy. And while it doesn't sound like something to celebrate, it kind of is when inflation is sky high and you realize that is exactly what the Federal Reserve is aiming for. Remember, their job is about economic stabilization, so consider it all to be a massive balancing act. The question is, can they really slow down the economy enough while ensuring our robust labor market remains, well, robust? And personally, I do not think it can actually be done, but wishful thinking is always nice. So yes, I'm a pessimist here, hence why you keep hearing me say that it is important to prepare for the worst, but always plan for the best. So where does that leave us? With companies that can surely make it through a deep recession, should one actually hit, which leads us to the 7 dividend stocks that I am fired up to tell you about, with our very first dividend stock of the day being Archer Daniels Midland, ticker symbol ADM, which for those of you who are not familiar is a multinational food processing and commodities trading company. So I want you to think about anything from sweeteners to flours and grains to starches and even fertilizers. Archer Daniels was founded back in 1902, so it has quite a bit of history navigating through uncertain market conditions, and since its founding they have only improved upon their operations with a current market capitalization of $46.34 billion. Now, in my opinion, with investors having mixed emotions about where and how to invest, we're seeing Archer Daniels slide to which it is already down by 4.5% on the year, trading for $84.47 per share with a PE ratio that is rather low at 11.6. But investors, should the market be heading where I think it is, safety and reliability is key, and have a look at this. Analysts are forecasting over 25% worth of upside with Archer Daniels, share price climbing back up to $106.33 per share. And of course, we're already beginning to see hedge fund activity. Not a lot, but certainly it is nice to see Dalio betting on Archer Daniels. However, as dividend investors, we will also be enjoying the Archer Daniels dividend with assurance, as it's almost a dividend king with a dividend yield at 1.9%, slightly above the sector average. Next up, I want to talk about Emerson Electric, ticker symbol EMR. It's a stock that was mentioned not too long ago on this channel, but look, I'm not here to entertain you. I'm here to present you with opportunities at the right time that will yield you, hopefully, better overall returns. So when it comes to Emerson Electric, a Fortune 500 manufacturer of a wide array of products for the industrial, commercial, and consumer markets, while also providing engineering services, this $52.63 billion market capitalized industry leader is looking at better and better, especially as it's been sliding already down 7.3% on the year, trading for roughly $89 per share, which I can attribute to companies in preparation mode for 2023 and foreseeing the need to really reduce expenditures across the board, which places Emerson in the line of fire, but also now opportunities for us investors with their PE ratio hovering around 16.4 and a nice chunk of upside expected with their stock share price forecasted at $103.45 per share, which is a little over 15% worth of upside. Of course, you better believe smart money has already been jumping in on Emerson Electric, increasing their positions by over 534,000 shares across the board. But let's have a look at their dividend, shall we? Emerson is a dividend king with over 60 years worth of delivering through on their dividend. That is above the sector average, coming in at a dividend yield of 2.32%. Now, before I cover these next two dividend stocks, I want to share that they are truly, in my opinion, worth a bit of a premium, and you can mark my words, they will hardly ever really drop below their true fair values, given the safety they really deliver. But it's these types of positions that I actually am not afraid to just dollar cost average into and scale over time. But let's just dive right into them. I'll talk about Procter & Gamble first, ticker symbol PG, which is, as I'm sure you know, a consumer goods manufacturer of literally probably anything you already use on a daily basis, from toothpaste to shaving cream, shampoos, diapers, detergents. Procter & Gamble is just a rock-solid $332.76 billion market capitalized behemoth that is really an ideal for a long-term dividend investor, regardless of the state of the economy. Now, at this time, their PE ratio is at 24.8, which again is on the higher side, but we do see its share price down over 8%, trading at $141 per share right now. And with just about everyone talking about more economic pain, it is no surprise here to see hedge funds just scoring more shares worth of Procter & Gamble, while analysts are also there to forecast upside with over 13% worth of it at a share price coming in at $160.43 per share. And again, we see another higher than sector average dividend investment with Procter & Gamble's dividend coming in at 2.56%. And if that didn't quite do it for you, then grab a salty snack and pop open a soda as we break down Pepsi, ticker symbol PEP, which is one of the largest soft drink manufacturers in the world with nice diversification in the salty snack arena as well, which has to be mentioned because a lot of investors compare it to Coca-Cola, but their snack segment actually drives 54% worth of revenue. So I'm just here to say that that comparison is really apples to oranges. Nonetheless, it's a $233 billion market capitalized company that has been sliding on the year. As we see, it's down nominally by 4.17% at the moment, trading for $170.94 per share, with that PE ratio coming in at 24.2. Now again, I know what you're probably thinking. Is that really so cheap? Yes, I mean, you're right, but the premium here is for safety. And think about this, you're buying a company that you can hold onto for a decade or even longer as a true dividend investor. But I do also want you to note that smart money is moving in on it when it comes to Pepsi, because perhaps I'm not alone in saying that Pepsi is a solid investment here as hedge funds just load up on this beverage behemoth. And as for analysts, we see 14.12% worth of upside, with the share price predicted to come up to $195 per share. Now, of course, it's their dividend that is going to make this one well worth the add to your watch list as a dividend king, with above average dividend yield coming in at 2.67% for their sector. Moving right along, if you're not feeling chicken enough in doing so, you can literally invest into one of the largest chicken, beef, and pork processors in the world, Tyson Foods, ticker symbol TSN, which is actually also the largest exporter of beef and chicken inside the United States. And while the company has been struggling, I think it is just worth noting that their lower quality chicken and beef may be exactly what the consumers will be flocking to as our economic conditions worsen. But what's more is that Tyson, a $23.21 billion market capitalized global industry leader, just invested over $20 million in Tennessee to expand production operations, which is a good sign when many companies are actually downsizing. And this is why I then love to see that the stock price is beaten down to $65 per share, which is over 25% that has been trimmed down from a year ago. Perhaps price is really what you pay, but value is what you're going to get when it comes to Tyson, especially with their PE ratio at 7.3. Now, we also see analysts favoring Tyson with forecasts coming up to $74.75 per share. It's over 14.6% worth of upside, along with smart money also scaling scaling up their positions, most likely for the longer term hold. And as we patiently await a share price rebound, shareholders will be able to beef up their dividend portfolios with Tyson's above sector average 2.81% dividend yield. As for the next dividend stock, I want to jump right into the healthcare sector and talk Pfizer, ticker symbol PFE, because it's not only a rock solid biotech to invest in, but because it played such a major role throughout the last couple of years, given the COVID pandemic, a lot of investors have been troubled with how Pfizer will continue to perform without the high demand of their vaccine. As a matter of fact, UBS just downgraded Pfizer, and all the negative headlines have been detrimental to its share price as it continues to slide, already down 12% on the year, trading for $43.89 per share. But investors, this is Pfizer, a $252.49 billion market capitalized healthcare pioneer, which if invested in for the long term will surely deliver through again. So I say with a PE ratio at 8.7, add it to that watch list of yours, but don't think for too long as Pfizer insiders begin to buy shares worth of the company back. It's a very promising sign, and smart money also has already begun to ramp up their positions with Pfizer as analysts give it a thumbs up as well, with upside predicted coming up to a share price of $53.20. That's about 21% worth of upside. Now, best yet is just the opportunity to get invested into Pfizer and remain patient, as a shareholder would be reaping the benefits of a 3.56% dividend yield. And last but not least, the dividend stock that I honestly cannot stop talking about, given its ability to truly deliver explosive returns while also shelling out a dividend. It is a financial sector investment with T. Rowe Price, ticker symbol TROW. Now investors, it's still down over 21% from this time last year, trading for $113 per share, which is even down from last week when it hit $120 per share, which should make all of us question, why in the world is this stock so volatile? Well, this $26.52 billion market capitalized investment management firm has most of its assets invested in none other than the tech-heavy NASDAQ, and with more pain expected to come for the tech companies, T. Rowe's share price will likely be in a state of flux for some time. But with its PE ratio at 13.6, plenty of hedge funds scoring boatloads of shares worth of T. Rowe Price, I think that we have a really incredible opportunity to simply buy, hold, and enjoy the volatile ride ahead of us, given T. Rowe Price's dividend that is way above the sector average, coming in at 4.04% worth of a dividend yield. And there you have it, investors, from Archer Daniels to Emerson Electric, Procter & Gamble to Pepsi, Tyson, Pfizer, and T. Rowe Price. 7 dividend stocks that you should not pass up before doing your own due diligence and investing into them, should any or all of these stocks make sense for your personal portfolio. Now, I personally would love to know your thoughts on these stocks, so be sure to drop those comments down below. And if you're ready to see the power of dividend investing and just how well my portfolio has been doing, then stay tuned for my next video. But as always, tap on that thumbs up button and subscribe to ensure that you're joining me on this financial journey. Now, investors, I will see you all in the next video.